Welcome to the Daily Update. This is being prepared Wednesday, May 25th, where we'll look at the action in the market today and then see how things look for Thursday, May 26th. And the big event that happened on Wednesday was the release of the FOMC meeting minutes. The market gyrated earlier in the day, but then really settled down. After the minutes were released, that was seen as pretty positive, and it took things a little bit higher. So that is helping our technical picture to improve quite a bit, but we still have a long way to go if we're going to switch back and look more positive. We're still negative overall, but we are showing signs of improvement. So let's go back over and talk about what happened on Wednesday. At the open, we had a pretty flat open. Buying took prices up to R1, which was at about 39.73 initially. As the day went on, prices fell back to the unchanged level, which is not really a surprise when you have a big announcement coming out. And there was minimal movement, went a little bit above, a little bit below, and then the FOMC minutes were released. After that, prices gyrated as they usually do, up a little bit, down a little bit, and then eventually defined some kind of a trend. We did move higher, and we almost got to 4,000. We were just underneath that. That ended up acting as resistance, so then prices ended up retreating back to R1, again at 37.93 at the close. We were up 0.95% on the day. Volume was below average. That's another thing to be aware of. As far as what we're looking at, the technicals, yeah, they're still negative. The path of least resistance is still down, but we're seeing some improvement. The markets are really fixated on inflation and interest rates, which then produces growth concerns, not only within a company, but we're also seeing that economically as well. Geopolitical concerns that have been the same all along, and then earnings as they are released by individual companies. What are some comments that we can make about the day? There was a positive reaction to the FOMC minutes when they were released. At the end of the day, small and mid caps ended up outperforming the bigger indexes. That could be a little bit encouraging. In a really strong environment, small and middle-sized companies are seen as riskier. They don't have the track record necessarily or the size that the big boys do. And when people are willing to get into those stocks, that means they're willing to take on more risk. Now, was this a one-day wonder? Is this something that's going to be sustainable? We don't know that yet. We just know that on Wednesday, they did outperform. The VIX is still producing some information that we're watching. It fell back a little bit from what I've been talking about lately, but I'm still keeping an eye on that. Fear still remains extreme. We're still really camped at extreme fear. We're still in correction territory and will be probably for a long time. The technical indicators are showing continued improvement. The economic reports that came out showed that durable goods increased. Okay, so that was all right at 0.4%, but they expected them to rise at 0.6%, so it was less than expected. That is taken a bit as a slowdown. Then when you take out transportation and figure everything out again, durable goods ended up climbing 0.3%, but they had expected 0.6%. So both of these parts of the same report were weaker than expected. Also, we had mortgage applications that come out every week. They declined 1.2%. Our trend is still negative and still getting stronger. It's not really shifting around that much yet. The bias, I've switched from mixed to negative to mixed back to positive. And our momentum is still mixed to negative because we're just not seeing a lot of technical improvement yet. Another thing I want to go through are just what are some of the takeaways that we can glean from the release of the FOMC meeting minutes. And this is a direct quote from briefing.com where it just says, market participants were presumably heartened, that means they liked it, by the notion that the Fed members want to move expeditiously or quickly to the neutral rate, and they're picking that at around 2 to 2.5%. And what they're trying to do is quell inflation pressures, and doing that rather quickly, which could allow the Fed to possibly pause the rate hikes later in the year and then assess the effects on policy firming. What does that mean in plain English? Raise rates faster now to help control inflation, and then down the road somewhere, focus more on economic growth. And that's pretty much the same stance that we've been told all along. So we really didn't see anything new there. One thing that I do want to mention, and I mentioned this in yesterday's video where I was going to include an extra section in today's video. Well, as I do research and prepare, it's turning into a full-blown video all by itself. So I'm calling that a supplemental video, and I publish those ever so often. A while back, I published a different video on the yield curve and what was happening there. And I just do these more on an as-needed basis. So a supplemental video is being prepared which will attempt to explain why the markets are having such a hard time producing a sustainable bounce. We're showing extreme fear. We're showing things being very oversold. Okay, we might bounce for maybe one day and it might be a strong bounce, but then we go right back down to the downtrend. We wear off the oversold conditions and then just keep going, or we flounder around and don't really end up anywhere. Why is that happening? And I'm trying to answer that in this video by giving you a hypothesis and some facts. I'm not saying this is hardcore truth. I'm just saying this is a scenario that I'm playing with, and I'll present some evidence to what I think is happening. The hypothesis is that the markets cannot sustain a strong and lasting recovery until the Fed makes a shift in policy that the markets really like. And I go back and I look at history and see other times when the market was just falling apart. It looked like it was the end of the world. All the doom and gloomers were just having parties. And then the Fed came out and announced something, and the markets turned and ended up recovering from there. That seems to be what we need right now. We already know what the Fed is planning on doing. We didn't get anything new necessarily from the meeting minutes. That's why we watch what members of the Fed say when they give an interview or they do a speech or there's some kind of article that's published about what they want to do. And if the market takes that, latches onto it, and goes, okay, we like this. Boom, we're going to send things higher. Well, I want to try to prove that and see how that's worked out in the past. The bounce is defined as possibly a counter trend move because a lot of people are saying we're in a downtrend, which we are. We're below on a long-term basis, intermediate term, and even short-term, we are negative. But we're not into bear market territory yet. So this could be a counter trend move, a move up inside of a larger down move. Or it could be a renewal of the bull market. We don't really know that yet. We're just playing out different ideas. And this is something that lasts more than just a few days and may even get back to the point where we get up to the all-time high and possibly even establish a new all-time high. And I'm putting together the things to show you what I'm thinking. I'm not saying it's right or wrong. I'm just playing a different scenario out to you. My intentions are to post this video as soon as possible, but it's probably going to be over the weekend. That's really when I get time to devote to something like this in addition to what I'm already doing. This will be added to as the list of possible positive scenarios. The hard part about this one is I can only talk about it. There's really no chart that I can show you. Where the other scenarios that I go through later on in the video, I can show you charts to tell you what I'm looking at, what I'm thinking. This is really going to be, let's watch the news. Let's watch and see what's happening and then see if that fits what we're looking for, if that ends up happening. And it might end up happening right away. It might be far off into the future. Let's go back and talk about the day's session. First, looking at sentiment. We're still extreme negative. We ticked up slightly, but we're at 14. And looking at our historical chart, it still just shows that we are camped out. The VIX actually declined because we had an up day, so it declined on a closing basis, but we're still above both of these moving averages. The bar chart shows that we closed just about at the low of the bar. The VIX of the VIX is also showing a decline because the VIX is really settling down. Here's the bar chart, and we really declined on a closing basis. This is the strange chart that I've been watching lately and talking about, and I added a few labels here where this top part is just a 5-period simple moving average of the VIX. So it kind of slows it down a little bit and just gives us the closing values. At the bottom is the S&P 500. What we're watching is in the middle, and we're watching this area over on the right-hand side. It came down a little bit, but if it goes above this dashed line, could that mean something to the markets? Another chart that I thought was interesting is that there's a thing in the market called short interest, and these are people that short a stock. And when you short a stock, what you do is you sell first, and then if it goes lower, you buy it back at a lower price. That can be negative. Yeah, there's some smart people that really want a stock or an index to go down. And they might know something that you don't know, and they're going to profit where I'm losing because I'm long. There's also another side to that. When you have a high level of short interest, you have a built-in group of buyers sitting on the sidelines. When they enter into a short position, they have to sell to get in. They have to buy to get out. And if prices really start to go up and they have to cover or get out of that position, they're going to have to buy to get out of it. And sometimes that's called a short cover rally or a short squeeze. What we're seeing here is the median S&P 500 stock short interest as a percent of the market cap. And it's really low right now. Well, when did it happen before? This was a little bit after the year 2000. That's when we ended up hitting a market high. This could be a little bit concerning depending on how you look at this, because there's not a lot of built-in buyers on the sidelines. And if we end up going higher based on this research, they're not necessarily going to have to come in and buy to push prices even higher. Another thing, and this is a screen capture from sentimenttrader.com, which is a very good website. And I look at their information and I subscribe to the website, and I would recommend that. I try to use their stuff sparingly because I don't want to steal other people's work. I want to give them full credit. But one thing that we're noticing here at the top is this is called small trader put call premium. This is not a put call ratio. This is how much of a premium are small traders, which is you and me, paying for puts and calls, whether we're buying or selling them. The idea is when options are expensive, you want to sell them because you bring in more premium. When there's not a lot of volatility, option prices go down and you don't generate as much premium. And I talk about that. That's one of the things that I go through is, are we in a trend? If we're not in a trend, we're going sideways. Premiums tend to come down in what you will receive if you sell a credit, either a credit spread or an iron condor or something like that. And that makes them less attractive, but at the same time, less risky. When the premium really goes up, that means that options are quite expensive. And this is the put call premium right here. We are really spiking right now. And you can see other times when we spiked at this level, that often marked a low in the market. Not always right on, but you go back, this is 2008 in here. We had some trouble in late 2015 into early 2016. This was kind of the Brexit Trump area right in here, even though it was a little later in 2016 that happened with the election. Then we had the meltdown on Christmas Eve, the mini crash. The premium that people were paying for options was very high at that point. And then when we hit the COVID low, the premium that people are paying for options really spiked up. We're getting to that point now. Now, we had an extreme reading not very long ago that did produce that nice bounce that we saw, but then we ended up coming back down. So this is just one thing that we want to keep an eye on. When this happens, sometimes that marks a market bottom. Another thing to watch for is the Economic Policy Uncertainty Index. It was released, and we saw a big increase from the last time I showed this chart. We're up to 312.11, and it's spiking up a bit. It could go higher than this, but at other times of economic uncertainty, we're getting back to similar levels. The Ulcer Index continues to fall, which this measures fear. It just shows on this basis, fear is really coming out of the market, and it may be picking up more of what's happening with the VIX instead of what we're seeing as far as our fear and greed index. And then a third alternative is this goes back 14 periods to calculate, and it counts back 14 periods, and it doesn't look as bad as it did before we saw this really dip down. Here's a longer term view of that chart, and we are more extreme than we've been since the COVID plunge, and we're coming down off of that. Equity put-call ratio declined, which can be expected on an up day, and here's the 5-period moving average of that. It's also declining, but still very high. Another thing that I ran across at IsabelNet is the truck tonnage against the S&P. It's like, what in the world does that have to do with anything? Well, in the month of April, it decreased by 2%. All right, so big deal. Trucks represent 72.5% of U.S. freight and serve as a barometer of the U.S. economy. The chart shows that the U.S. stock market tends to increase in line with the physical size and expansion of the U.S. economy. The truck tonnage index is not a leading indicator of the stock market, but it's very interesting because it shows the U.S. stock market tends to follow the physical expansion and contraction of the U.S. economy. Okay, here's the chart. And there's something to this. We have the purple line here. This is the S&P. The gold to yellow line here is the truck tonnage index. And they tend to move more hand in hand with each other. But look what has happened now. We really spiked up after the COVID plunge, where we didn't see a corresponding increase in the truck tonnage index. And so are prices coming back down to get more in line with this? Or does the truck tonnage index need to increase to make up the difference in price of the S&P? This next chart just shows the dotted green line is the ISM manufacturing PMI, which came out yesterday. Then you also take the core CPI, which takes out all the important things and comes up with what the rate is for inflation. This is the 12th month change year over year. They take what the core CPI is right now, they take the ISM manufacturing from 12 months ago, and then put them right on top of each other, and we can see how they kind of correlate with each other. At least the uptrends and downtrends do. Well, lately, we've been seeing the green dash line really decline as the core line is also declining. Another chart that's really hard to read, and I had to blow this up over and over while still trying to maintain the integrity of the chart because there's all these small little words on here. Basically, we can sum this up very simply. This dash line across the middle, when we're above that, that means people are using a lot of margin. When we're below that, that means margin use is decreasing. We're getting to an oversold reading, which is at about 2. This is called a Z-score, and when you get to that level, you're showing kind of an extreme reading. What has happened at other times when we've been down about at this level? Well, we had March 2020. That was a low. We had the low that was set Christmas Eve. Then we had some problems in 2011, 2012 that I'll talk about in the video. Here's the low in October 2008. Here's a low from 2002, December 2000. So when we get down to this level, this quite often has marked a low in the market. We're getting to that level now. Let's go through and look at the sectors. We had an up day, so discretionary, which has just been getting shot all year, actually performed the best at 2.8%. Energy was up over 2%. Then we had comm and tech over 1%. The laggards were Staples was up slightly, where healthcare and utilities were actually down slightly. And here is going back to the all-time high. Energy is still in the lead, followed by utilities. And discretionary, comm, and tech have really been taking up the rear. Technical alerts, all positive. The NASDAQ crossed a bunch of levels during the day. We did get a positive BPI cross on the chart, and I'll show you that here in just a moment. There's really nothing else that applies to the S&P, but these are positive. We're kind of seeing some technical improvement. Can it last? Can we see some follow-through for a change? That's what we're trying to decide. Intraday, all right, going way over to the right-hand side, we were pretty much flat. We gyrated around a little bit at the open, but we ended up kind of just sitting along the unchanged level. Some buying came in early and took us up to R1, but that didn't stick for very long. So we went back down to unchanged, kind of camped there. And then the FOMC meeting minutes came out, and that took the markets higher. We almost made it up to 4,000. We retreated from that, and we closed right at about R1, just a little bit above that for the day. What I did is, here's a 1 minute chart just to show you how things are. We have the opening way over on the left. We have the unchanged level, the dash line, and things just kind of danced around and did what they did. This is when the meeting minutes were released, and we shot up, then we shot down, then we started to establish more of an upward trend, almost to 4,000 before seeing the majority of selling coming in, and we closed at 3978.73. This was not as crazy as it can get, but if you notice along the bottom, you see where volume really picked up after the minutes were released, because a lot of people, they don't really want to do anything ahead of some kind of a major announcement. The daily chart, we were able to get right back above and close right about on this pivot level. That's interesting. So we're trying to regain what had been resistance is now possibly acting as support. Down at the bottom, you can see where we saw a drop off in volume, and it was below average. We're down 17.05% from the all-time high. Going through the technical overview, this hasn't changed, so I'm just going to click through these really quick. The things that have been positive are still positive. We haven't seen that big of a change yet. The things that were negative are still negative. And when they do, I would like to be able to update this, but I haven't had to do it now for quite a while. Let's go back and look at the trend. We're seeing a decrease in selling, an increase in buying, but the ADX is still above the moving average, even though it's flattening out a little bit. So we are in a trend. It's still strengthening, and it's negative because the red line is on top. The Arun is showing a decrease in selling, but also a decrease in buying. So we are flat overall, but we're negative when you compare both sides in our oscillator. Looking at the breadth, we had a pretty good day with breadth based on price and volume, where we advanced right up to the moving average. We also saw an advance based on volume. The 10-day average of new highs and new lows, it's continuing to improve, and I put an arrow in here. I look at this as the waterfall chart. That's kind of what it looks like to me, but I will adjust this arrow as this moves. The advanced decline ratio, we're right about in the middle. New highs and new lows, we're seeing some improvement there. We're starting to trend higher on the 5 period, and we're starting to move up with the 10 period as well. We're above the moving average with the accumulation distribution, so that's positive. Now we want to see, can this moving average turn up? We have a bad down day and we go below it. No, that's not going to happen. Looking at some short-term charts, the McClellan oscillator continues to advance and is not necessarily extreme. The force index is still negative, but showing some improvement. Stochc RSI starting to get into extreme positive territory, where the Williams percent R is trying to come up above the dash line to turn more positive. Ultimate oscillator, it's been jockeying around the 50 level. Well, now it's slightly above 50. Our moving average study shows an improvement with the 20, 50, and we're still flat pretty much with the 200. Stochastics showing some short-term improvement as well as some intermediate-term improvement, and still floundering around to actually declining a little bit in the longer term. Intermediate-term charts, rate of change, we're now out of an extreme negative reading that we had been reading as of yesterday. Our momentum oscillators, we're seeing a mixed bunch here. The slope is positive, the MACD is turning positive, the KST is trying to turn up, where the TRIX and the PMO are still negative but looking a little bit better, and the TSI is trying to go slightly positive. The vortex is still negative. We're seeing a decline in selling and an increase in buying. Sean trend meter is still extreme negative. The STO showing an improvement based on price and volume. BPI, this is what I was talking about with the technical alerts. We bounced above 30 and that is an oversold reading, which could be positive. But beware, we had one of these not too long ago, only to have it come up and then dip right back down. The PMO is showing some improvement, but it's still negative, whereas based on price and volume, they have turned positive. The PMOs that are rising are advancing. The buy signals are advancing, and we're turning up slightly to flat with those PMOs in the S&P that are above zero. Summation index based on price and volume continues to advance. The boom indicator is still extreme negative. And there's another area I might add in the middle here, which goes and looks at a 20 period moving average. I called this the 20 yesterday because I'm playing around with this. 20 is more short term, 50 is intermediate term, and then 200 is longer term. That's how I use them. But they're still negative overall, even though we're seeing some improvement. Chaikin oscillator is looking better. Ease of movement bounced up. Chaikin money flow showing some improvement, turned positive yesterday, is a little bit more positive today. One thing that is a concern is we're not seeing a real intensity when it comes to volume, which is not surprising. We're having below average volume right now, so any move is getting picked up as a weak move. We can't really trust this yet if we're relying on volume to confirm what's happening right now. TTM squeeze, we're below this anchored moving average, which is acting as resistance. Can we break above that? We're down below. We are showing some improvement, but we're still negative. And here, looking at the oscillator, it's trying to come off of this extreme negative reading. Our different charts, Heiken Ashi, open candle, that's positive. Kagi chart, turn black, that is positive. Renko, still negative. 3-line break, still drawing some up bars here, so that is positive. Our different trading systems, we're still neutral with the S&P and the Elders Impulse system, as with the SPY. This is a biggie. You see the dot down below with the SAR? That is a positive signal. That could be something right there. So we had been negative overall because the dots are on top. Now the dot is below. We're switching back to a more of a positive stance based on this indicator. But beware of this. You can really get whipsawed for a long time before this thing decides to change. And just because it's positive today, we have a rip-roaring down day, it could easily put another dot back up on top. However, our go, no-go system is still dark purple, so that is negative overall. Longer term, we are below the 200-day moving average. We're showing some improvement in our longer-term moving average study, where we're bouncing up from being extreme negative, going up slightly on the 150 and the 200. Special K continues to decline, but we're seeing a little bit of a hook right here. But we're going to have to see a lot more than what we've seen already. Looking at the broad market, the diamonds are back to being positive. The Dow's held up better. It's been down too, but it's been holding up better than some of the other indexes. Where the Qs, they're back to being more neutral. They've got more damage that needs to be repaired if we're going to, in fact, start going higher. The Vixen is really decreasing on the NASDAQ 100, even though we declined slightly on the closing basis. Looking at the broad market, the dollar bounced up a little bit. We're still trying to figure out, okay, have we spiked? Are we going to be able to bounce up from that, or did we just see a little blip up before the dollar gets ready to head even lower? Oil was up 0.5% at 110.33. The gold futures, they're still messing around with the 200-day moving average. Can they stay above it? Can they stay below it? The ETF is above the 200-day moving average, and the average is acting as support right now. Here's a longer-term view. Silver was down 0.25%, and we're in danger of seeing a death cross. And here's the longer-term view of the ETF. Bitcoin is still just camped out right around 30. A little bit above, a little bit below. Looking at bonds, we are seeing a continued bounce. As interest rates are going down, that means bond prices are going up. Can this continue? Yields are still dropping, where we have the 10 and the 5 that are just kissing each other back and forth. The yen has been weak but bouncing, as has the euro. We're seeing the dollar, which had been strong, still declining overall. And here's just a comparison between the euro and the dollar. We're also keeping an eye on the relationship between the S&P and interest rates. And we're seeing that this is still a pretty high relationship, meaning they're going in the same direction. If interest rates are down and stocks are down, this line goes up. If they move in the opposite direction, this line goes down, and we get to the point where they have an inverse relationship. It's still rather strange, but it's still what we're seeing. Also, I haven't brought this up in a while. We're also seeing a strong correlation between the tech sector, which has just been getting hammered, and the 10-year yield, which has been coming down, and they're at the point where they're moving more lockstep with each other. But this is really strange. This just shows a lot of confusion in the markets. Our possible positive scenarios: the Kopik curve is advancing. Is something going to happen? Is it going to be up or down? 2-year Treasury, it's come down a bit here, but we don't know for sure right now if that is a spike or not. Mass index still has not produced the second part of its signal. The Pring bottom fisher, it is moving up, so that would suggest that a move, if it's strong, would be up, because that's what this indicator measures, bottom fisher. The small caps saw a bit of an increase, but not a real noticeable spike. That's why I mentioned that the small caps outperformed. I was hoping this chart would show a little bit more action. What we want to see is more follow through from the small caps. If they really outperform the S&P, then after that, we might see the S&P end up going up. And then we came back up. This is still looking fairly viable, where we really came down with the staple spike, and we came back up. Now we fell back down again. So we're still trying to figure out, is this a spike? So then what is our outlook for Thursday? Technicals are negative, but yes, they continue to improve. Sentiment remains extreme negative. We're still battling back and forth between growth and value. The economic reports that'll be coming out, this could be a big one. We have the second GDP estimate. The GDP comes out quarterly, but we have the initial one, or the advanced reading. Now here's the second one. Then they'll come out with the final one. Then they'll come out with the revised one. It's like it goes on forever. We also have weekly jobless claims and then pending home sales. But GDP is probably the bigger one, but we've already seen that first number and it was negative. If it's not negative, if it switched back to positive, that could really help the markets. Or if it comes in weaker than it did last time, that could really be negative. So we'll be watching for that one. Geopolitical events, Russia, Ukraine. Again, could be positive or negative depending on what happens. We have supply chain issues that seem to be getting a little bit better, at least on the surface. We haven't seen real follow through from that yet because they're lessening the lockdowns in China. Inflation and interest rates are the big concern, which are producing the growth concerns. We want to keep an eye on oil, earnings as they come out, Fed speak, and then policy. And this is what I'm talking about. What kind of policy could the Fed come out with, whether you agree or disagree, whether it's moral or immoral, but the market still likes it anyway, and it shoots prices higher. That's kind of what we're waiting to see will happen. But it doesn't seem to have happened yet. And then we're also keeping an eye on things in Japan, but that's much longer term. So our scenarios are, we're still down overall due to rising interest rates, inflation fears, growth concerns, earnings, Fed speak, policy, fear, Technicals are still negative, but they're showing some improvement. What could make us go up from here? We are seeing some improvement from the technicals, and sentiment is still extreme negative. The possible positive scenarios. I can't really put the Fed policy on there yet because we don't have one. And I can't really put a chart on there. I'll just probably list it in this part if something like that does happen. The Kopik curve and the Pring bottom fisher, they've turned up. And the staple spike, I want to see it go down a little bit more than what it's already done. So it's not looking as viable, but more viable today than it was looking yesterday. As far as the technicals, we're looking at pivots, fib retracements. I didn't show any of those today because we're far away from them now. And previous levels that may provide either support or resistance. And then we're not in a sideways pattern right now because the ADX is still above 20 and that trend is negative. So our conclusion then is the S&P is negative. Short term, it's negative but showing some improvement. Intermediate term, also showing some improvement even though it's negative. Long term, we are still negative. So thank you. Have a wonderful Thursday, and I'll prepare the next video after Thursday's session. And yes, I run this out a little bit longer so that the end screens on YouTube don't overcover what I post and make it harder for all of you to read this. And also, if anybody's still listening to this now and hasn't clicked away, let me know what you think of the zooming that I'm trying to do on the videos. I'm trying to bring the charts in a little bit closer so that you can get a better look at them.